investment offering we're proud to present, and that is the Hamilton. Nashville MSA, 232 unit property. It was built in 1985, but mind you, it was been heavily renovated with a full renovation of the interiors in 2020, and then they've replaced all the roofs in 2024. So when you look at it, it feels like a 90s or a 2000s property. This is an affluent suburb. There's 3 major affluent suburbs in Nashville. Hendersonville is the one in the north, and that's where this property is located. An attractive place to attract the right demographics.
So as Vic mentioned, the Hamilton is our next acquisition. We are very excited about it for a whole bunch of reasons. Because of the extensive work and the high level of care that the seller has taken on the property, it shows even better than a typical 80s product. 655 unit square foot average. It's a very efficient floor plan. It's a very efficient property, which is definitely helps manage it also in an efficient manner. So one of the great things about us that stood out is the cap rate, right? We are getting this at a north of a 6 cap, and that's even with the loan assumption. So the positive leverage day one is inherent in the deal. It's been managed very well, very efficiently. This is a seller who we've bought from previously. So we've already transacted with them. We've seen how they manage, and efficiently at 36%, they've really managed to dial down the property to an efficient operational level.
Because of our relationships, they came to us and said, hey, would you be interested in taking this down? We stuck to our pricing, and so we were able to get close to almost $1 million discount on the deal when we acquired it as well.
Highly occupied. This thing has been 97 or 98% occupied for at least 16 to 18 months. They redid the clubhouse, nearly fully renovated already. We're getting a strong cash flow just from the kind of lower purchase price. It's an institutional quality asset that's been owned by several institutions before us, and they've taken really great care of it. Business plan, very simple here. It's already cash flowing at a good cap rate. This is a high income area. No one here wants to use a laundry room. They already started installing washer dryers in the units for the $40 to $50 premium that you get for making those installations. There's some organic rent growth that's already been going on site. Vic mentioned projected 5% rent growth in the market. We've underwritten less than that to be a little more conservative there, and still drives higher cash flow. Continue as the seller has done to optimize expenses and just efficiently manage this property. The fact that we have revenue upside, given the low risk, is the asymmetric risk reward that Vic mentioned earlier. That is what we strive to look for. Here, we're still getting 70% leverage on our purchase, which is right around the threshold we actually aim for. And Vic already talked plenty about the location itself. A lot of industry here. Gap has their headquarters a few miles away. This is the suburbs of Nashville. We're a northern suburb. I've seen in the comments, people asked, what about the supply? We've read about the news in Nashville. That's all downtown. There's been an undersupply here in the northern suburbs, which is what's leading to the continued rent growth, whereas other parts of Nashville are maybe seeing a little bit differently. One thing to highlight here, which I want to mention, is the delta to in-place rents versus the average market rents in the market. There is almost a $400 difference between the rents on site here to rents elsewhere in the market. What that makes us is, believe it or not, despite the high quality of the property, it is actually one of the low-cost alternatives in the market. So we have protection almost $400 above us to being an affordable option, which is what's driving the very high tenancy of this property. We expect to stay that way. We expect to capture a whole bunch of that delta, but not all of it, because that's what's driving the high quality occupied rent roll with very high quality tenants.
For those who haven't invested with Viking before, we set up all of our deals with a 3-tiered equity structure. And what that means is that you have 3 different classes. You have Class A, you have Class B, and what we call Reserve. Class A is going to really prioritize cash flow. So you're going to get 10% preferred return built into the economics. So that means you have priority over the other classes in the deal. What you're giving up to get that prioritized cash flow is you're giving up the profit share at the disposition of the asset. The minimum investment for Class A is $50,000. Class B is going to be the flip side to Class A on your common equity share. So you're still going to have a 7% preferred return. Now the cash flow that you're actually going to get from this deal is going to be based off of the cash on cash, the average over the whole period, which we'll discuss on a later slide. But in addition to the preferred return, you're going to get the 70-30 profit share when we sell the deal, meaning that 70% of the profits are going to be going to you as the LP, and Viking gets 30% of the share that represents its promote. This also carries a minimum investment of $50,000. Reserve class is a class that enhances the returns, increasing the preferred return to 8%, and also the profit share from 70-30 to 80-20. And this is reserved for folks that are investing $500,000 or more.
This property is fully amenitized. There's a beautiful pool. There's a fitness room. I'm going to do the clubhouse here. Really well, tastefully done by the seller and the seller's design team, leaving us some work but a lot of the heavy lifting, already done. The plank flooring, fireplaces, stainless steel, granite countertops, these are really high quality units. There's a pet park, there's a tennis court that we're going to be repurposing into probably pickleball and other amenities that will be a little more to date. Great floor plans. Again, it's easy to see why it's getting top tenants. Very efficient unit mix here. A lot of one bedrooms, about 80% of the property is one bedrooms, just about 20% two bedrooms. For this pocket of this nature, we are getting a lot of the kind of ancillary employees, some more single, young, professional single folk filling up this property. There's some really nice cottage end units in this property as well. Even though it's a one bedroom, it feels like a 2 or 3 bedroom. So it's a really nice unit mix, very efficient layouts. We walked every single unit, and then really each unit shows very nicely. Rent comps. We've looked at all these comps, analyzed all these comps. It's a really great set of apartments, all drawing great tenants. MAA, number 7, for example, Mid-America, they're one of the top developers and owners in the country. I think they're almost $500 above us in rent, really offering an ability for us to be that affordable option, stay occupied with a lot of room to increase rents while staying affordable. But again, still on the path of growth. There's a lot of jobs out here. I mentioned Gap. This is where those jobs are being supplied. So this is very much the path of growth. This is not the hotels here about Nashville or Music Row. This is where the jobs, this is where the workforce housing is thriving. Hendersonville is kind of the main city in this area. Top schools, great economic drivers, a lot of young professionals, workforce, the population thriving and continuing to grow. Vic mentioned the 125K average household income, 75% of the tenants in the white collar workforce, but still a healthy amount of rent or occupied housing. And great retail nearby, great nearby amenities for tenants. Top grocers, we sit right between a Publix and a Kroger. If I had to pick 2 grocers in the Southeast that I want to be between for workforce housing. The lake nearby has been a historical attraction. It's what kind of founded this community. You see almost $2 million home prices nearby. Again, very much insulating the renter market. So it's become a destination within greater Nashville submarket. So many different industries going on here between major sports teams, major economic developments, office properties. Everyone obviously knows about the Music Row and the music industry. There's $5+ billion of economic impact, all just several miles from our property. Can't underscore this enough. Education, education, education. It drives tenants, it drives the workforce, it drives the quality of the area. And having A-rated schools, the number 2 best district in the Nashville MSA, will only kind of perpetuate the rest of the area going forward.
I just want to talk about Nashville. It's been rated as number 1 by real estate investors as a place to invest, leisurely travel, ideal working age population, best city to watch. Growth is real, right? This is from a lot of the population data from 1910 to 2070. They're thinking that the Nashville population is going to grow 37% more than the national average. They're expecting to add 600,000 new folks to the MSA in the next 10 years. We mentioned the discrepancy in Nashville of renting versus buying. Average home price in Nashville is $535,000. The mortgage on that is $3,100. Average rent is $2,000. That's already a $1,000 affordability gap. Remember, our rents are at $1,300. We have a lot of room to go up, and it's still going to be much below owning. It was a high growth rate in 2020 as number 8 in terms of where people are moving. No imposed payroll tax, no state income tax. Very attractive place for workers and for businesses to relocate. Amazon, Nissan, state government, Dell, Oracle, Vanderbilt, and all the medical hospitals that it runs, Kroger. These are all big name places that call Nashville home. The employment growth was 2%, outpacing the national average at 1.4. This is interesting because when Nashville is adding so many hotel rooms, what that tells you is there's more business travel, there's more tourism, there's more eyeballs and people getting on airplanes to go see Nashville. So it's all about the economic engine that it provides. Dolly Parton has been integral to some of the economy. We have the Dollywood building new hotels. Theme park, $1.8 billion. The airport, $2.1 billion. Expansion. Nashville Yards is a development project, $2 billion annual economic impact, anchored by places such as Amazon. The corporate relocations due to the tax and the workforce and the corporate-friendly tax environment, it's unmatched, right? $36 billion of economic impact from all the relocations. Amazon itself has a huge couple of towers, 3 million square foot facility, 5,000 jobs, $4 billion of impact. Oracle, same thing. Being an educational center, they call Nashville the Athens of the South due to all the universities that are available. Belmont, Tennessee State, obviously Vanderbilt, ranked number 14 in the country. Between the university and the medical center, there's about $22 billion of economic impact. In and surrounding our property, there are 500 healthcare companies and probably 100 hospital systems. So it's quite a healthcare capital as well. And probably on our property, as we're finishing up our due diligence, we'll probably find ed and med, if you call it. So there's a lot of educational type of jobs on the property and probably a lot of nurses and medical folks that are actual tenants. Tons of tourism, $20 million a day. Nashville is considered music capital of the U.S., $5.5 million of impact. It's also the home to the Country Music Awards as well. Luxury shopping is available. There's a huge $300,000 redevelopment site. Meta, also known as Facebook, $1.5 million data center, which is in Gallatin, which is slightly north of Hendersonville. This new Nissan stadium, this is where the Tennessee Titans will play. I think it just got built or it's coming online. University of Tennessee and Virginia, for example, that one game had $20 million of impact. Professional soccer, MLS soccer, National SC, $77 million of impact. And the Predators are their NHL team that's in the Bridgestone Arena, $410 million of impact. So you can see here, tons of sports teams, tons of things to do. Number one place in terms of markets to watch. So it really is a robust place to live, work, play. And that's why we think this is really an outstanding project. For those people who are looking for bonus depreciation, we still are able to offer it 40% this year in 2025. There's multiple ways to invest in this project. Self-directed IRAs. If you invest a certain dollar amount or more and you bring in a network of people, you can launch a fund. You can invest with cash, self-directed 401ks, trust, and 1031 exchanges. The whole period will be 4 years with the option to potentially refinance and hold longer if needed. But right now the plan is to exit in 4.
Where are you typically getting your capital to fund projects?
Right. So our investor base is pretty broad. We have individual LPs, high net worth folks. We also have several family offices. We have, bigger institutional partners that we sometimes partner with. It's really the whole gamut.
Okay, great. People are really asking you more about the loan terms, Judah. Can you just tell them about the loan term, the assumable loan, and then if in 4 years, if and the environment's not right, what are our options as the sponsors?
Sure. So the seller has already taken out a senior loan and a supplemental loan, both from Freddie Mac. These are Freddie Mac loans, 30-year amortization schedule, blended at a 4.89% interest rate. Again, already fixed, already in place. We're past IO here, which means the loan is amortizing, which is nice. When we make our debt service, we're not just paying debt service, we're actually paying down the mortgage on a monthly basis as well, which lends to the next question you asked, Vic. In 4 years from now, it'll be beneficial to have a lower loan balance, but we have two options. If the property's cash flowing nicely, we can continue to cash flow it and put a new loan in place. If it's a advantageous market to sell, we can sell the property in 4 years. So having optionality is always a good thing. So it's great to have a fixed rate loan now to avoid the market volatility that's still present, while having optionality in a few years from now as to whether or not to sell when the loan matures in 4 years, or whether to keep the property for another year, 2 or 3 or 4 years, just having all that optionality in place. I think ideally, let's sell it in 4 years. We will have completed our business plan, but having that optionality is always an extra layer of protection.
So an investor was asking, why is the current owner selling?
Great question. The seller here is closing out one of their funds. So their fund has reached maturity. Once the fund reaches maturity, they have to return capital. The only way to return capital is by selling the properties. They bought this in 2018 or 2019, I believe. So they've reached their 6 or 7 year maximum period of their investment, and they're selling. They had a little bit of wiggle room on timing, which again, they went to market with this back in the summer, ended up not selling due to the other buyer not being able to perform. They had some time to figure it out, reached out to us, because they very much started feeling the pressure to sell the property. So that's why they're selling, fund maturity.
Someone was asking, hey, why are rents so low? And isn't one bedrooms less desirable?
No, one bedrooms are desirable, which is being shown by the 97, 98% occupancy on site. It really depends, who you are as a renter. The market itself has a nice balance of 1s, 2s, even 3 bedrooms. Another question I was asked here was, what's the size of these units? And is that why there's delta in pricing? Yes, we are, I said, the affordable option. We're also one of the smaller options. A lot of tenants would rather spend a little bit less money, even if it means having a little bit of a smaller apartment, especially if they're a single young professional or maybe a retiree. So kind of answer all those questions into one, the market has proven a very strong demand for 1 bedrooms and 2 bedroom apartments, which is why this thing has stayed occupied despite the seller having continuously raised rents, despite the seller having kind of started adding washer dryers and charging for them as well. The business plan has already been proven in place. We get to kind of carry it to fruition.
Yeah. And then why are rents so low, Judah?
Yeah, rents are low here relative to some of the newer properties that were built. There were a couple of new properties that were built and delivered as we showed on the slide. Those were fully leased up because there's such a strong demand here. But relative to those newer properties or 3-4 bedroom apartments, we are 1 bedroom, so we will have lower rents. And it's 85 built. So while the property is in great shape and does have granite, does have stainless steel appliances, in comparison to some of the brand new product charging much higher rents, we are charging appropriate for where we should be. It just keeps the property very competitive and very occupied.
Chris, this is for you. What are some of the risks you see with this property and investment?
Yeah, I think that, we really like to isolate the risk. So one of the risks that you tend to see in 1980s built properties is usually part of the plan is to do a huge value add component. And we're fortunate with this property and, the value add component's been done. So the idea that we have to spend a lot of money, increase rents, that's kind of been taken off. The big risk here, I think that I would kind of point to and say this is what you should still think of after everything we've done to mitigate is where cap rates are going to go. I think most folks, you look at where we're buying this property north of a 6 cap, it's definitely a great deal from a cap rate perspective. The question is, in the next 4 years, are cap rates going to compress or are they going to expand? If you believe that interest rates and lack of new supply coming online in this area is causing cap rates to expand, the logical thought would be that you'd see some cap rate compression over the next 2 or 3 years. And that's why I was for going against what I typically like, which is putting like a 10-year loan on this to get more flexibility. So 2 risks that I'd identify is 1, will there be enough cap rate compression over the next 4 years to sell this property and get the value that we want to get out of it? That's one thing every investor should ask themselves. The second one is, do you believe that transaction volume and the lack of supply is going to continue? I think with lack of supply, you have to look at, you can't build 1980s properties. So even if over the next couple years, developers see the opportunity in this area and they say, we want to build in this area because there's undersupply, they have to build top of the market. We had that slide that showed what that would cost and where rents would have to be to justify building with construction costs today. So that's why I think Judah pointed out really, correctly that the property, it's hard to replace this value and have a 1980s property that you can rent at these prices. You just can't recreate that by building more.
And what is the timeline for this deal, Chris?
Yeah, so typically, and this was no different, we hope to close the property within 60 to 75 days of launch, which is right now. I think what we've engineered into the agreement with this deal is up to 90 days with a 30-day extension, but the goal would be to close in the next 60 days. And I think we have the traction to do so.
And so people are asking, Chris, if we can share like our underwriting or our pro forma and how we got to these calculations. Is there a way for them to learn more about that?
Yeah, absolutely. So my team and I have developed a deal room. We're going to be sending out follow-up emails after this webinar with the replay of this. I usually will do a performer review video. Any of you guys that have been with us for the last few deals have seen these, where I usually will walk through the model line by line with a few investors and ask them if I can share that. So that will go out to you to where if you don't have an hour and a half to sit down with me and go through it yourself, there'll be a recording that you can watch and we'll go and point out, and that's where I really can point out any risks that I really identify or soft spots in the deal. I definitely implore everyone to watch that video. And then, of course, we would share the model, we would share any information that you're looking for. And we're very transparent about the way we underwrote the deal and how we came to these conclusions. Just reach out to us and you'll get what you're looking for.
And then, Judah, who's going to be managing this asset? And then if we have a property management company on board, how does that work?
Absolutely. So we will be working with Pegasus Residential to manage as a third-party manager on site. They'll be the ones, kind of their staff, in the leasing office, their maintenance staff on site. However, Viking very much will be the asset manager, meaning we will be overseeing them. Edmund Archick, our director of asset management, he's already been on site with me, toured the property, walked the units. He will be on weekly calls with the whole team, making sure leasing traffic is what it should be, making sure that the construction management and renovation projects are progressing accordingly, and making sure that all the tenants are being taken care of and that we continue to have a positive reputation. So we very much manage the project along with Pegasus Residential, who will be the on-site team.
There's a question for Chris. Can people invest using different investment vehicles? Like, is there a 1031 option? Is there an IRA? Things like that.
We're definitely set up to take self-directed IRAs. On this particular deal, it isn't set up to take 1031s, but we do have other investment opportunities that are open that do take 1031s. So if you need to quickly identify or you have 1031 money that you're looking to place, do reach out to our team. We have options available. It's just not this property.
And people are wondering, despite whatever class they end up investing in, do they get a K1 at the end of the year?
Yes, so anyone that invests in this deal through any investment vehicle will receive a K1, and that's going to detail what you invested. It's going to show the depreciation, your share of the depreciation that can be used to offset any passive income you might have. And it's also going to detail the passive income that you receive from this investment on an annual basis until we sell.
So people who invest, Chris, if they're interested in the bonus depreciation, how does that work and how will they see that reflected?
Yeah, so I can explain it in more detail. If you really want to dive in, please call my team and myself. But generally, every property will have a cost segregation study done. And the way that cost segregation study works is they go to the property and they itemize parts of the property into 5, 10, 15, and 20-year buckets of how long it takes, different parts, the roofs, the washing machines, concrete, the pool, what depreciates at what time. And they will accelerate that depreciation as much as they can based off of each item and what bucket it falls in. What you're left with is economic report from the cost seg economist that says in year one, you can depreciate this much value. So say it's $10 million. In this year, with the step down that's been happening in the step down of the depreciation program that's allowed, you're able to take 40% of that and actually utilize it in year one. So if there's $10 million from the cost seg study, you can take $4 million, and that $4 million will be spread equally amongst all of the investment amounts of money that gets invested into the deal. Viking, as a sponsor, takes none of the depreciation. It gets spread equally throughout all of the LPs. And then once you have that depreciation in your K1, if you have any other passive income, so think not your W-2 income, think if you own a rental property that you're renting out and you're getting income, that's passive. Any of the income that you get from this investment, passive. Other investments like this, passive. You'll be able to use these losses to offset those gains and not pay taxes until you recapture when we sell the property. Like I said, it's pretty complicated, but one-on-one calls would probably be best to really dive into the minute details.
Absolutely. Great work, Chris. People wondering, hey, when's the first distribution after closing?
Yeah, usually the way that we set that up is 45 days to 60 days after close, we start paying distributions, and they come monthly.
So the question that we're having a couple of them is, this is actually a funny one. It was like, can we use the property on the weekends? If they were flying in, hey, maybe we should make it an investor suite just for the investors. Why not? But in seriousness, some of the questions were, hey, how do you feel you're going to be well capitalized and underwritten, despite the good rates based on, market volatility?
Yeah, so one thing we do when we underwrite is our goal is to fully capitalize up front. That means for all of our capital projects, construction projects, repurposing of tennis courts, amenities, landscaping, anything that's capital below the line, we raise money day one to be able to fund throughout our investment period. So we don't hope that cash flow will sustain the capital project. Cash flow is what our investors earn and what we pay out to them by distributions. So we make sure that everything is budgeted. We already had contractors come out to the site. We've already been building up our budget. So we'll know every dollar that we plan to spend before we close to make sure it's all accounted for.
And Chris, can you go through the minimums again?
Yeah, the minimum investment is $50,000. And the minimum for reserve class, which has the stronger economics as a reward for a higher investment amount, is $500,000.
I encourage you guys to go ahead and book calls. We have already a significant amount of interest on this deal. We think it will close pretty quickly because we haven't had a traditional value add deal in a while. And so people have been asking for one of these. And so for those of you guys who are interested, there's a link in the chat box. So the team, can you put the link in the chat box for them to book a call? You can scan the QR code. You can text Hamilton to that number below. And the email we have is invest@vikingcapllc.com. Historically, deals like this, because not that many people are doing deals in the country right now, these things do fill up probably in 30, 45 days. This will be probably a full commitment for most investors. So we urge you guys to come, ask your questions, make sure you feel comfortable. And if this meets your investment thesis and investment criteria, we'd love for you to join us in the Viking family.